My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for there is Joe Carlasare, who I know a lot of you have seen on these spaces. Joe, you and I have interacted, but the first time you and I are chatting. Introduce yourself to the audience and to me. What's your background? What have you done throughout your career? And why the focus on crypto?
Thank you, Michael. It's an honor and privilege to be here today. So my background begins actually as relevant to this discussion here is starting as just a amateur investor trading at a custodial account with my father when I was in grade school. I really became an absolute student of the markets, love it, and invested in trading in some way or another for almost 25 years now, which is an eternity. Seems like an eternity at least, and just how things have changed. And I've always been a student of economics and had a deep passion for how markets work and particularly, free market forces. But I made the mistake of going to law school, which I say that in jest, but it is a very difficult profession. But what I like to bring to it is, for my clients, the core of my job is really to assess risk. Because at the end of the day, as a litigator, right, no one can guarantee an outcome. All I can really do is try to sort of assess the probabilities, range of success based on the strength of the evidence. But you have a human being making decisions, whether it's a judge or a jury. And I have to really just make a simple calculation there of, does it make sense to pursue it further and take it all the way to trial, which I love to do. But also, I have the good sense to realize the vast majority of disputes should settle. And that's the best expected outcome you can given the set of facts you have. So, I bring a sort of a market-based approach and a risk assessment-based approach in my professional job as an attorney, but also, with my own money, investing it and analyzing the markets. Like I said, I love getting into complex systems and trying to understand the secondary, tertiary effects of how things relate. So in my day job at Amundsen Davis, where I am a partner and the co-chair of the cryptocurrency, fintech, and blockchain practice group, I saw a unique opportunity going back to the better part of 6 years now, where I saw this new, growing, exciting space. At the time, I was more of a open to all sorts of different cryptocurrencies. I've since sort of centered my focus more on development of the Bitcoin space and helping miners, helping other content creators and nascent businesses come to market, and also trying to give them regulatory advice while at the same time trying to get them out of litigated disputes. Which, if you're growing fast and breaking things, as they say, you tend to get into litigated disputes very frequently. I was excited about getting into the world of cryptocurrency, mostly because it would let me tie my deep passion for markets with my expertise and background and all the money I paid for that fancy law degree. So that's generally the background of me. I got some of the first orders in Cook County relating to digital assets, folks that were required to turn over their keys in certain circumstances. Back when people, had zero clue what was going on in the space, I had to go in front of old gray Cook County judges and explain to them, how a distributed ledger technology works, how a blockchain works, how private key, public key cryptography works. And it led to some really interesting moments there trying to explain this stuff to folks that perhaps were still struggling to change the time on their VCR at the time, which is shocking. But yeah, that's generally the summary.
How do you go about providing guidance on regulatory frameworks, on case law, when there's really nothing in the precedent? Right? I mean, obviously you can draw parallels, but I got to assume from a litigation perspective, it's hard to exactly pull up case law when it comes to Bitcoin and cryptocurrencies in general.
Yeah, I mean, that's exactly right. When we were getting folks even back in the ICO craze that were approaching our firm, got some sort of seasoned series lawyers that were trying to just grapple with the technical aspects of it. They said, very clearly, like we can't guarantee anything with this. There's just so much uncertainty and so much doubt. What we can do is we can tell you sort of the best case scenario, the worst case scenario, and communicate it. And one of my mentors always told me it was important, if you're advising any client, is to set expectations, right? A lawyer cannot really go in there ever in any circumstance and tell you with 100% certainty you are bulletproof. If he or she is doing that, they are not a good lawyer. Because even in a case where you think you're bulletproof, even in a case, Michael, where there is extraordinary precedent, you would be shocked how many times where I go into court, I have a bulletproof case, I have a great clause in a contract that should guarantee my client a win, but the judge says, well, I'm going to let this thing go forward. I'm not going to dismiss this matter just because we think that the plaintiff should have their day in court, and we want people to have their ability to have a chance to have cases decided on the merits. Totally wrong, right? Not the law, not the precedent, not what has been established through case after case. But like I said earlier, whenever you have a human being making decisions in our system, you have that sort of risk. You have a risk for that they're not going to follow the law, right? Or that they're going to expand it or create some way of distinguishing the law. There's this saying in the Ethereum space mostly that law is code, right? That just put the law down and be agnostic to human beings and their sympathies and their emotions. That's so fundamentally opposed to how human beings interact with one another and how psychology influences people. It's so different from real world applications because I can tell you so many different times where for a variety of reasons, people make an excuse. They justify whatever cause or end they're trying to reach. Judges do this, juries do this, and they rule in opposite to the law. So I always like to say, code isn't law. Law, it's the exact opposite, right? The law is built on vagaries and sort of limits of human being interpretation. Ideally, you'd want someone to follow the law, but it's not going to necessarily always be the case. But to answer your question, in the form of this space, right? There are pre-existing structures. There are analogies you can sort of try to tie together. And all you can really do is sort of show the spectrum of risk. And I think what many learned in earlier cycles, if you will, of the crypto markets is they felt like they were untouchable. They can get away with a lot of fast and loose behavior. And I think now that we've seen sort of a watershed moment where that is not going to be the case for much longer, both not only from the government side, but from the civil litigators, which we'll get into, the class actions that are coming by, the plaintiffs' lawyers against some of the launchers of these tokens and digital assets. I think it's totally underpublicized how big that's going to be if these things continue.
That is a good direction to go because we're used to seeing the headlines and it's like, SBF felt like it was so long ago, but, to your point, there's still going to be a whole lot of other legal action. So is there any sense of sort of how long the delays would tend to be in terms of these class action lawsuits? So shit that went down last year that was egregious and outright scams. I got to assume there's a almost like a bullet amount of type of cases are going to be coming through soon.
Yeah, absolutely. So let's go back just a little bit and a little history lesson real quick here. So obviously the launch of the XRP token, right? That was years and years ago. And the SEC did not file suit until December of 2020, if memory serves correctly. So I think they had more than 3 years where they were going back and forth with tolling agreements. And they were basically saying, we're going to extend the statute. We're going to try and negotiate something. We're going to try and bring some sort of settlement here without having to go through the court process because the court process is very slow, as everyone knows. So they did that for years and years. And I think they finally, pulled the trigger in December of 2020. After they did that, right? Like we're now sitting in June of 2023 and we still don't have a decision. And guess what? Spoiler alert. One thing I can tell you with absolute confidence is that once we get a decision from the district court judge, we will get an appeal. And that almost certainly, whether the SEC prevails or Ripple Labs prevail, either side's going to be unhappy with it and they're going to go up to the next court level and they're going to seek another decision. So that can drag the whole process on for another, year or more. And I think to your question here is regulators, I think purposely because of SBF, which we can get into a little bit, and his lobbying efforts, they were hands off, perhaps more than they should have been during most of 2021 and into 2022, because there was hope that there was some sort of omnibus crypto legislation that was going to get passed. They thought that there was perhaps going to be some bill through Congress that would say, we don't need to file all these time-intensive regulatory actions, enforcement actions. What we can do is we can just rely on Congress to do things. Well, when SBF and FTX blew up, what did that do? That left Democrats and Republicans with egg on their face. SBF made more than $93 million in political donations, so much so that the bankruptcy court's trying to claw back some of the political donations he did. I think some of the other top FTX executives made another $50 million. They're some of the largest Democratic donors to individual candidates. So Congress said, we can't touch this because we're sort of tainted. So now regulators, enforcement chiefs, CFTC, SEC, DOJ, take the gloves off, go do what you need to do, file what you need to do. And I think you've seen a ton of litigation. I've heard privately of a lot more coming. And I know that the class actions are going to start flowing like water. I've seen counted 25 in the last 6 months. So that pace is going to increase, right? It increases with more people understanding the space, more people coming forward and raising their hand saying, I lost a lot of money. Let's go after these guys because they made a lot of money. And it's going to be a bigger story, I think, this cycle than it was in past cycles. When the market was so much smaller, Okay. There really wasn't as much of an incentive, I think, for some of the trial lawyers to get involved and pursue these claims. Now, as it's gotten so much bigger and particularly so many folks lost money on some of the altcoins during the last cycle, you have a lot of people that are raising their hands saying, I need relief. And whether it's going to come from private civil litigants or from the government, be prepared to, get strapped in for that. Well, of course, it depends on who's settling, right? If the SEC is settling, that's a different story than, if there's some sort of DOJ settlement that would be used to pay restitution. Obviously, if private litigants are settling, not just necessarily class action, but there's a lot of actions that are brought by individual investors, folks that, they put $10 million towards a token. They got it really early. They got effectively the pre-seed token, the pre-ICO of the token. And they never, materialize on what they were actually getting. And, those are all, a lot of those there can be confidentiality clauses that are entered in. So we don't even hear about those. Lots of people in crypto prefer, confidentiality, which is not dissimilar from many other industries, right? You can enter into those confidentiality agreements. But, most of the time the money is, in the case of the SEC, it's not actually finding its way back into the hands of the so-called victims. I will tell you that most of the civil and even the DOJ, they do publicize when there is some sort of broker negotiated settlement. So you'll see the press releases, you'll get some of that. But the private litigants, no, you're not going to see any of that, because if you were in the position of representing some token issuer, right, you may pay a pretty penny to resolve a case and, may get involved in that transaction. But ultimately, one of the conditions you're going to broker in that settlement is you are going to say specifically that I want it to be a confidential sealed settlement agreement, and you will breach the settlement agreement after you give me back the money if you reveal the terms. I will sort of start with sort of framing the space. Okay. And I think it's illustrative to go back to, Three Arrows Capital, to some of the other well-documented entities last year, because I think the problem you tend to have in the space is there's really only a handful of counterparties, right? There's really only a handful of market makers in this industry. And I still think, if I'm advising any one of them, just be quite honest, and some of them we do. So, I have to be careful what I say, but, there are, when you say they're regulated and compliant, I will push back on every single aspect of that, because I can think of scenarios where a judge would disagree with that. Just take the Coinbase suit very briefly. Okay. Coinbase has been operating for years now. It's a publicly traded company, and the SEC has taken the position that they are not licensed and regulated as a broker dealer. They're not licensed as a clearinghouse, that they are an unregistered exchange operating in the United States. They're taking the exact same position with Binance. Okay. So I guarantee you there were lawyers that told them at the time that when they were launching, listen, there's always a risk that they can come down on this side of this, and this is how this could ultimately be interpreted. But the core of that is that you could copy and paste the allegations in the Coinbase complaint, and you could mirror it and file it against any other exchange in the United States that is selling many of these tokens, many of these unregistered securities. You could literally copy it and paste it. It's not germane specifically to their company. Robinhood sells some of these securities. Okay. They've since, delisted them, but you could say that you're operating an unregistered exchange because of these tokens and how they're constructed. So the point is, like, again, what I said at the beginning is that this is always a spectrum. And the real answer is we don't really know, because what the industry was hoping for, what I think SBF spent over $100 million lobbying for, was black and white, clear law from Congress, okay, that was going to clear this up and try to remove these issues of doubt with respect to custody, with respect to the assets. And we didn't get it. And I don't think we're going to get it for a long time. All my contacts on the Hill says that crypto legislation, maybe excluding a minor bill regarding stable coins, is really out the door for a while. And that you're going to continue to have, regulation through enforcement, which means that you're in this horrible position if you're a market participant, because you have to literally wait for court orders to get handed down. Oh, and by the way, when you get those court orders, they can always be appealed by the next court. And right now there are 2 judges in 2 different districts deciding what the requirements are to operate a crypto exchange in the United States. One in the Binance case, one in the Coinbase case. They're sister districts where they could rule in opposite to one another. Then what do? Then you got a circuit split. So you got a whole host of confusion in the industry. And it's the whole reason why we should have clear laws on this from the exchange standpoint, rather than just leave it up to the courts. Leave it up to the courts is the lazy way. And I think it just speaks to how ineffective the current Congress is. But, with the Prime Trust, let's talk about the Prime Trust. So it was announced that the Nevada Financial Institutions Division filed an action, a cease and desist order, trying to take over the Prime Trust and seize all of its assets. And they cited in this wellness check they did back in November, where they determined that there was a shortfall of the shareholder equity, and there were some issues regarding some of the deposits. It was kind of opaque, but then they realized they were actually having trouble meeting some of the deposits of various customers on withdrawals. We don't know to what extent. Today, we learn more that they're significantly undercapitalized for deposits. So let's just talk about what that is. This is a vehicle that was supposed to be designed to have customer assets, to custody customer assets. Okay. Now, what does that mean? What is the custody rule and how is it applied specifically in the context of digital assets? I can give you very well-reasoned interpretations of how it should be applied. But there's still gray area, right? Because we don't have the clear precedent. But for our purposes, what it illustrates is that you had an entity that was licensed, that was monitored by the Nevada regulators. And even though you had those in place, they still ended up with losing some of their customer deposits. We don't know why. We don't know how it lost them. We knew it was operating with the equity deficit, but we don't know how that doesn't make sense to how the customer deposits went missing. That's a real confusing issue. And it's really, I think it's a serious black eye in latest in a string of these for the industry, because what it shows you is that you still have just a handful of market participants, and for whatever reason, they still can't get a control and give customers the sort of confidence that you need in this industry. And when there's a bank run, when there's shortfalls, there's no FDIC to come in. In fact, I would guess, based on some of the information we received from very reliable sources, that it's all the regulators want many of these institutions to go under. I'll just cite one brief example. Signature Bank, which obviously went under and was aiding and supporting many in the crypto industry. There is fairly reliable evidence from folks like Barney Frank, former head of the House Financial Services Committee, a Democrat, not exactly known for being pro-crypto. He said that Signature Bank was killed because of crypto, because of its affiliation, that there was no reason that bank needed to be pulled. And there are some public documents that have been produced that show that for the sale of their assets, they wanted it to go to a bidder who would not be associated with any crypto industries. So you've got sort of this, Operation Choke Point 2.0 that's referred to by many as what it is, sort of a soft influence effort to try to get institutions not to support this particular industry. What does that do? That forces operations and activities into a handful of companies, all of which have counterparty risks to one another. So when there's a liquidity shortfall, a whole house of cards boxes. And that's really scary if you're trying to grow and build in this space. One of the companies that I follow very closely, Swan Bitcoin, they were trying to do a Bitcoin only type brokerage operation where, they wanted to have Bitcoin only services offered to their clients. They ended up having a custody provider with the Prime Trust, right? And that's obviously problematic because they're, even despite their reluctance to be associated with anything associated with altcoin world, that was sort of their ethos of the company. They ended up getting tied into the altcoin market by virtue of the Prime Trust, which is exposed and has its tentacles into the rest of the crypto space. Here's the problem. In just practically speaking, if you look at what you actually see on your screen, when you see numbers bouncing around and Bitcoin bouncing around and the balance of, at FTX, they were showing many customers balances of Bitcoin, and it turns out they didn't have Bitcoin, right? Is that you have to be able to find a technological way not to just prove that the entity has or does not have an asset, but that asset is somehow earmarked to you specifically. Let me explain a little bit more. When you're trading on a lot of these platforms, okay, the real issue is is their back-end trading engine, is it supported by assets on chain, right? And the answer in many cases is no. Like in Voyager in particular, we know, for some of the filings now, that when you were buying Bitcoin, right, you were really buying an IOU that promised for them to someday acquire Bitcoin from someone else. And that's how they were operating as a business. This is based on public documents. This is not my opinion. You would say, oh, I have one Bitcoin in my account at Voyager. They didn't have all that Bitcoin because the way they made money, the way they actually, were profitable as a company for the brief period of time was they were lending that Bitcoin out to someone else to then go speculate it on in the marketplace. And there were almost no rules, or at least clear rules about prohibitions on this. In fact, when you executed the terms and conditions of your Voyager agreement, right, it permitted them to rehypothecate, meaning lend out and reutilize that particular type of collateral. And I would say in a space like Bitcoin, where you have a finite amount of Bitcoin that are in existence, and that can all be monitored, that gets very dangerous if they're lending it out and they're not properly assessing counterparty risk. That becomes really difficult. So, to answer your question, like, is there a technological way to marry the specific account balance in your account on these crypto exchanges with a blockchain data, some signature on the blockchain? Maybe that's more of a technical question. I mean, obviously that would give a lot of confidence. Other people have thrown out ideas about proof of reserves and so forth. But, what we see consistently, and I think this is the key thing, you have these exchange of businesses and they have to make money. So how do they make money? Well, they make money, number one, based on trading. And we know from the Binance activities that, there's an allegation for Binance complaint, both the CFTC complaint against them and the SEC complaint, that there's allegations they were trading against their own customers. That's one way they're monetizing it. The second way they're monetizing it, aside from trading against their own customers, was lending it out to folks. And pick your poison. Either one of those is bad in my opinion. So I'm not going to use the term loose because I think I have to appear before a regulator. I don't want a copy of this podcast, which is going to get, hundreds of thousands of views, right, Michael? I don't want it to be used against me.
All because of you, Joe.
I will tell you this. There are jurisdictions who look at the space more favorable than others. Okay. Most notably is Wyoming. Some other ones you actually wouldn't expect. I mean, we've had success with some clients in places like Alabama, right? More rural states. And I think one of the reasons for that is you just get a little bit more face time and access to some of the regulators. They're not as swamped with so many issues. I can tell you, I'm based out of Chicago, and Chicago and some of the regulators here, they will openly tell you that they have real animus towards the space. And I've sat down and talked with them, and they'll just say that they think it's all just fluff and a scam, and takes a lot of hardworking people's money, in particular disadvantaged communities. I've literally had that told to me directly, and I've been given permission to share it. So, I think that overall, I think that some of the more smaller states, those are probably your best bet to have more favorable interactions. But I think Wyoming in particular, they're at the top of the list in terms of some of their more forward-thinking regulation on the space. The opposite of Wyoming, I think you're going to easily find in California and in New York. California and New York are probably the two most hostile environments. I think DAOs are extremely dangerous, and we've counseled clients on this. And again, this is something I'll spare you some billable hours on this.
And sorry, just for the listeners who don't know what a DAO is, explain that too.
Yeah. So in simplest terms, okay, a DAO is a vehicle that is, it stands for Decentralized Autonomous Organizations. It's a type of entity structure, basically where there's no apparent central authority, right? Like the DAO itself, the entity is controlled by the token owners. Those who own tokens can direct the entity itself on how to interact. There is, some developing case law on this that should give you pause if you're trying to pursue this types of structure, because there have been courts now entering default judgments against the DAOs, and now there are going to be efforts to collect against the holders of the tokens, even though ostensibly it is decentralized, right? We don't control it. Token holders all have equal participation and have the ability to pass off any sort of liability. I can tell you, I strongly reject that notion. I think that in the right circumstances, in the right set of facts, there will be folks that will come in, regulators in states that are very zealous, and they are going to go after anyone who is seen as being the apparent controller, operator, distributor of the token, right? So the notion that you label it decentralized and therefore it is. I think that will continue to be proven to be a mistaken concept. Now, I'm not against them in principle. I just think that there are states that don't recognize them. There are states that are going to challenge it. And when you put these organizations in play and you put serious money behind it, to me, if I were putting it together, I would not want to experiment, with considerable amounts of money in high stakes litigation to allow, for example, the CFTC to win the default judgment against the recent one in California. That is a difficult dynamic to be in, and you're playing with fire. You're asking to be the test case. You're asking to be the first guy through the door who may get shot.
That's a hell of a soundbite. Yeah, at the end of that, that was good. Okay, so I am curious to hear your thoughts now on how big this Bitcoin ETF news is. A lot of people have been making a lot of noise around this. First of all, do you get the sense that narrative is true, that BlackRock wouldn't be doing this unless they really believed it could pass? And then past that, is it really a game changer, or could it be in some ways maybe a bad thing for Bitcoin? Sort of the other side of the argument.
So I'll just tell you my overall, I'll start before we get to the legal part. I'll tell you my view on the ETF. So I understand the desire for the ETF. I'm sort of agnostic about it. I mean, I think that they would probably, like most of the major, like the futures ETF resulted, folks trying to lead the price up before it actually came to market. It was a, perfect sell the news type event when the futures ETF launched. Similarly, in December 2017, when the CME launched futures contracts, that was also, the height of the market, another classic sell the news event. I suspect that if you got an ETF, if a registration statement was approved by the SEC and it came to market, I would guess the price action would mostly be front loaded and probably peak up the market for a while after that actually came to market. That's just my theory on it from a market participant perspective. But, I understand why people want it. There's a lot of accounts that, it would flow capital into it, and that capital's trapped in certain accounts where they can't buy, native Bitcoin. I'm not opposed to it on principle. I think it probably should make sense and should get approved. What I would tell you from a legal standpoint is that the SEC has had a position which I find to be largely illogical. Their position has been that because they have surveillance sharing and monitoring agreements with the CME, they are confident that the CME futures market is capable of detecting quote unquote manipulation of the futures contracts. They have no doubt that a market of sufficient size can be detected. It can detect and monitor manipulation. That's the core of their reasoning for greenlighting the futures ETF. They say we're going to allow this ETF to come to market because effectively we have no concerns about the futures contracts. Well, to me, just basically a student of the markets, there is a symbiotic relationship between futures and spot. Many people, hedge with one or the other, and you have to sort of have one hand in both if you're a big enough player. So I don't quite buy the logic that which the SEC advances, which is that we can't really be sure that the spot market is similarly situated to the futures market. In other words, the SEC's position that they've taken repeatedly through multiple denials of orders for years now is that there's no surveillance sharing agreement with exchanges of sufficient market size to be able to detect manipulation. And keep in mind, the SEC has repeatedly said in their appeal against Grayscale right now, which we'll get into, they have said that our job is not to prevent market manipulation. Our job is to detect market participation. That's what at its core, we're trying to do. We're trying to be able to detect market manipulation. And because the majority of the Bitcoin spot market trades in these offshore exchanges, which are black boxes, and we can't figure out, is there spoofing going on? Is there wash trading? Is there, exchange-based trading? We don't have confidence in the integrity of that market. And even if we did, we can't monitor it to see if something might change. And that's why until you get a surveillance sharing agreement among the major exchanges, markets of sufficient size, we're not going to greenlight the spot Bitcoin ETF. That's what they've said for years, by the way. Now let's talk about this latest, fervor that's going on. So it's driven primarily by one thing, a single thing, which is that BlackRock made a filing. And then after BlackRock made the filing through the iShares proposal, there's a number of other entities that tagged along. Now, let me tell you what my hypothesis is on this, and I may end up being wrong on it, but I still think it's probably should be your base case, is that, as I mentioned, Grayscale, which operates the GBTC trust, is suing the SEC, saying that this theory that the spot market and the futures market should be looked at differently, and that you're refusing to green light a spot ETF, that is an arbitrary and capricious decision from the SEC. It doesn't make sense. It's imposing an undue burden on the applicant for the ETF. And because of that, appellate court, you should decide to reverse their decision, direct the SEC to reconsider their approach. Now, they had oral arguments on this back in March. And if you listen to the oral arguments, the judges were somewhat pressing of their questions with respect to the SEC's lawyers. I mean, if you're just going off oral arguments, which is dangerous in my job, because a lot of times oral arguments can flip them and go the other way. In oral arguments, I think many market participants thought that did not go well for the SEC. So I think what I view this recent onslaught of ETF registration statements is I think it is basically a hedge. It's an insurance policy that you may get a favorable ruling in the Grayscale case. And if you get a favorable ruling, then obviously the SEC could reverse their position. And by the way, they're not going to just approve one ETF, right? They will approve multiple ETFs, similar to how they did the futures ETFs. There's the BITO that launched, but there are others that were futures-based ETFs that came to market. So if you're BlackRock and other market participants and you think there's, a reasonable chance you get a favorable ruling, you want to have your registration statement pending, filed, ready to go. You want the clock to start running, and hopefully you get some favorable news out of the appellate court in the Grayscale case. And if that is the case, then if there is some favorable news, then you're already in the queue. You're already hopefully on a path to getting some approval. The opposite is also true, right? I think that there's very little material distinction between the BlackRock application and the others. So if the arguments didn't succeed previously, why would the SEC just suddenly change course and change policy simply because iShares and BlackRock slapped their name on it? I know there are folks that think that's enough to move the needle. I don't. If they did prevail, okay, and that was the order, there's timetables set for the other applications. Typically 45 days, there has to be some response after the filing. So, say based on the timetable, you get some favorable ruling in the next 30 to 60 days, right? Theoretically, they could green light the other applicants, even while Grayscale undertakes the efforts to convert. With all due respect to the regulators, I don't think they're playing 4D chess or anything here. I think you've got a lot of different moving pieces in a fast-growing industry. And I think that the SEC, as we've shown through some documents that have recently come to light in these so-called Hinman documents, that they're still crafting and trying to develop their policy on this. I mean, they've been doing it for years now. And I think that the problem they've had is that they really have sort of ping-ponged back and forth on how the best approach to handle the industry. And I think they were really hoping, I think Gensler in particular was hoping that there would have been some legislation passed, as I alluded to earlier. So I don't think it's this game of 4D chess. I know there's a lot of people on Twitter that think that's where they're at. They're just reasonable people in a lot of situations trying to do their best. And unfortunately, there's turnover and there's people leaving and coming and different directors and different chairs taking office, and they might have different views. But at its core, I think it's sort of a confusion. It's more of it's driving a lot of this. But the broader point, though, I think, is that let's talk about the BlackRock application, the iShares registration statement. So their registration statement for the ETF, okay, they are going to be using Coinbase primarily for their custody. Okay, now the interesting thing about that is that the SEC, okay, to whom they're applying for the registration statement, has taken a position in SEC versus Coinbase, filed that Coinbase is neither a registered exchange, neither a registered broker dealer, and not a proper registered clearinghouse. That is litigation that is filed. It's an existential threat against Coinbase in the United States, because what the SEC is seeking is to bar them from custody solutions and bar them from exchange trading activity in the United States. So to say that that's going to be somehow put their mind at ease because Coinbase is at the heart of their custody and some of their pricing mechanisms. I think that's a real stretch, guys. And I know people say, don't underestimate BlackRock. They've got everything figured out. They're the masters of the universe. Maybe they are. I can't say anything for certain on that front, but I would just tell you that I'm highly skeptical considering similar pricing mechanisms, similar custody solutions were proposed in prior applications, which were denied. Again, the custody rules on this are basically the best guess of some fine legal minds. There's significant gray areas, as I alluded to earlier, in custody and the requirements of custody. What kind of, whether the compliance with the so-called custody rule and how that actually is influencing space. There's a lot of ambiguity that still remains. And to me, bringing it back to what the early part of this discussion revolved around is that, we're, years into this space here, 6-7 years, multiple bull runs and lots of money flowing in and, lots of notable high profile people embracing the space. But the crazy thing to me is that, I remember hearing back in 2015, 2016, how, Wall Street's coming, the herd is coming, and there'll be major players and there's major trading desks that are going to come on Wall Street for digital assets, right? And we still have seen, in my opinion, a pathetic amount of development in that era, right? And that's a real big question. Why is that? Why do we still not have, like a NASDAQ type custody solution that is accessible, reliable, that has significant volume, significant market share? You have to ask that question. Why is it still dominated primarily by offshore exchanges? And it's the key to all this, right? Because I think that if you had sufficient liquidity and clarity and you had major players in the space, you wouldn't have these sort of blowups that we're seeing that seem to be on like a monthly basis now.
Joe, for you, I mean, obviously you're, and I commend you for this, branding yourself as kind of the go-to person when it comes to thinking about litigation and the intersection of law with cryptocurrencies, Bitcoin. What do you yourself get out of this? Is it a function of you're just passionate about the space and you want to see a better framework? You want to be at the leading edge of that? Just talk about some of your own motivations.
Yeah. So, I in particular, as I get older and as I look at more of the space here, I have gotten more and more passionate in terms of my belief in Bitcoin and very little else. My initial reaction to almost every other project is probably one with skepticism. I don't really buy into much of the hype in DeFi. I never bought into the metaverse. I believe that you have a real innovation. The mathematical purity of Bitcoin is inspiring to me. I think that as a technological achievement, it is worthy of probably a Nobel Prize. Now, obviously, there's been a ton of negative consequences of it that we can get into, and I don't dismiss any of that lightly. But I'll just tell you, like the actual innovation of that, the ledger behind Bitcoin, the robustness of the network, the fact that Bitcoin is specifically built to withstand nation-state attacks. Those sorts of things, I think, are fantastic. And I think if you were trying to design some sort of nascent monetary system that was an alternative, okay, I think it would look a lot like the early days of Bitcoin. Now, whether we can move past some of these shenanigans in the broader crypto space and really focus on what Bitcoin can do, and I do think there's a ton of work needed to continue to Bitcoin on Bitcoin. I mean, there's desperate development that's needed to get to scale to be a real payments network. I mean, I know that Bitcoiners really say, well, Lightning Network fixes this and other layer 2 and layer 3 solutions do that. I believe that, yes, that's possible, right? But you're going to need a lot of development, you're going to need bigger players and really coordinated efforts to expand those layer 2 and layer 3 solutions in a way that can scale. So I don't think it's just a fait accompli where it's just all done and, it's a finished product. I think that we can get there and it's exciting. And I think there's increasingly every day where Bitcoin doesn't blow up and completely fall apart. I think there's a less than zero chance that we can win and succeed and get Bitcoin to scale to global scale. But to me, the interesting part about Bitcoin, I think more so than any of these other things is the aspect of the self-custody solutions and the censorship resistance. And I think in our world where you seem to see a push towards the opposite, where you see increasing censorship, and you also see issues with having to rely on custodians, I think that is appealing. And it's that alone, the use case of that alone, I think presents real freedom and opportunities to a lot of people across the globe. Now, is that what it looks like today? Are the people in developing nations in mass that are using it? I would argue there's probably more data that show people are using stablecoins and Tether, right? But again, I try to look forward and see okay, is that always going to be the case? Can that change? Can that dynamic evolve as things change on the macroeconomic landscape? I know there's a heated debate that I often weigh in on, and whether we're headed for inflation or deflation or those sorts of things. To me, I think that when you have serious problems in the legacy financial system, a legacy monetary network, and you have this other alternative, it's worthy of at least consideration and a hedge and position in that alternative. If you're trying to figure out and dig into the nuance of this, where you should actually start is not the filing by iShares, not by BlackRock. You should start with the grayscale appeal against the SEC, because what happened in that appeal is you get to see the SEC's basic argument as to what they're looking for in very good detail, because they're trying to convince a judge why they're not being arbitrary and capricious. In other words, why they're not just unfairly and irrationally denying Grayscale's effort to transition to an ETF. And what they give in great detail is that they're saying, we want a market that is of sufficient size so that if someone was trying to manipulate the quote unquote spot market, if they were trying to do that, they would necessarily have to trade on that exchange. That's literally the language they use. Okay. So what does that mean? Let's just break down each part of that. So they're looking for a surveillance agreement that would not prevent fraud, but it would allow some onlooker to detect, okay, there's clearly a coordinated effort here to try and manipulate the price of the spot market. There's waves of selling coming in or waves of buying and very thin order books, et cetera. And we can detect this in real time and we can intervene. Okay. So the question becomes, that standard, a market of sufficient size, an exchange of sufficient size, is that met by Coinbase? Is the surveillance sharing agreement with Coinbase and with NASDAQ, which is part of the BlackRock submission, is that enough? And to me, it seems like it's not enough, because number one, there have been prior registration statements that had very similar structures with multiple US-based exchanges with volume that exceeds Coinbase, and those were denied. And from my standpoint, even if you had that surveillance sharing agreement with NASDAQ and Coinbase in place, which the BlackRock one does, you still are at, by my rough estimates, less than a third of US-based, or excuse me, less than a third of global spot volume. The majority of global spot volume is ex-United States. So if you're going to say that it's a sufficient market size to that a market manipulator would have to trade in that exchange, I'm not so certain that would meet the standard the SEC wants, unless you got at least one of the major foreign exchanges.
Joe, for those who don't want to track more of your thoughts and just reach out to you if they have questions, how do people find you?
Yeah, you can follow me on Twitter. DMs are open, but I would prefer if anybody has litigated disputes, or they're an entrepreneur or innovator, they're trying to develop business. We have a full service law firm in practice here. I'd be happy to work with you, especially if it's blockchain, crypto, fintech related. You can reach out to me, Google my name, my firm pops up right at the top, and shoot me an email. I'd love to work with it. I got about 60% of my practice now is in the space. So really, really enjoy it. And thank you so much, Michael, for the opportunity.
Thank you, Joe. Thank you, everybody, for joining. And hopefully I'll see you all next time. Appreciate it, everybody.